Do you earn a portion or even a majority of your income from commission? This video is going to explain exactly how underwriters analyze commission and how you can beat the system to qualify for your next home purchase. I'm Jennifer Hernandez, lender for lots of years. I've done this since 1995, and I have helped lots of people get through commission. I'm no stranger to commission myself. Since 1995, I've actually been on 100% commission as a loan officer. So I understand that there are ups and there are downs. The goal is to have consistent, but commission can be earned in many different ways. Again, it can be monthly, it can be quarterly, it can be annually. So when we're looking in underwriting, that's what we're going to go over next. So underwriters, the way that they look at income is first they establish how often is the commission paid. And the first thing we do is look at the year-to-date pay stub. So if someone's on commission, they've been with the company for, let's say, 3 years, and we don't see any commission on the year-to-date pay stub, we're going to be like, where's the commission? Is it paid annually? Is it paid quarterly? We're going to look to the employer to answer those questions for us. In summary, we need a 2-year average of commission. So we're going to look at your last 2 years W-2s, but the W-2s don't tell us how much was commission and how much is base. Let's say that you're an employee that makes a $50,000 base, and then you make commission on top of that based on, having to meet some metrics, right? So by looking at the W-2, everything is lumped together, so we can't tell. So what we do is we go to the employer, we get a verification of employment form, or you could provide the lender with your year-end pay stubs for the last 2 years. So you could, the very last pay stub you received in December is going to have the total amount of commission on the paycheck. That's another way you can do it to get it done very quickly. So when we have the last 2 years, last year and the year before's commission, we're going to take that and average it by 24 months, which is two years. 1 year is 12 months, 2 years would be 24. Then we're going to also look at year to date and make sure that your year to date is on the right track to be the same as the average. So I'm going to give you an example here with some real numbers. Let's say last year your commission was $20,000, and the year before that your commission was $15,000. So we add the 20,000 plus the 15 and we get 35,000. Then we divide that by 24 months, which is 2 years at 24 months. And the average we get is $1,458. That means that $1,458 is your average commission over the last 2 years, and it's kept in mind the ups and the downs. So furthermore, we're going to look at your year-to-date commission. We're going to look at your pay stub. So if we're looking at your pay stub early in the year, it's really hard to tell. If we're in September and we're looking at 9 months, we're going to want to see at least $12,000 worth of commission to show that that's on track. If you take $1,458 and you times it by 9 months, if we're seeing your September paycheck, that's about $13,000 that year-to-date commission should be. So if it's lower, we're going to be a little bit skeptical, like, hey, has your commission plan changed? Are you not meeting your metrics? Is business down? So we're going to likely take the lower number of that year. It doesn't matter what the 2-year average is. If it's September and your year-to-date is $8,000, if you divide $8,000 by 9 months, that's $888. That's a lot less than $1,458. So we're likely going to actually want to get something from the employer to make sure that the commission is expected to continue, but we're going to use that lower average. So if you take your base, let's just say that everything worked out fine, your year-to-date matches what the 2-year average is, and that in the example we're using, that's $1,458, and your base is $50,000. We're going to take your base of $50,000, which is $4,166, and we're going to take the commission on top of that, which is $1,458, and that gives us a total income of $5,624 a month. That's the income that we're going to use to calculate your debt to income ratio. There's one more important thing that you've got to know. You're probably wondering, Jennifer, if I've changed jobs and I'm commissioned, what do I do then? Because I don't have the 2-year history with that employer. Not to fear, you can definitely get a mortgage. However, you've got to have 12 months at the new gig in order to show established commission. And we're going to look at that because we know that you've been a commission employee before. We're going to do a verification of employment for your prior job that was commission. And then we're going to look at your new job and we're going to take 12 months of commission that you've earned and we'll divide that number by 12. We're not going to use your prior commission from the prior job. We're just going to use the current job and we're just going to divide it by 12. So you've got to have 12 months at the new job when you change employers. So I hope that helps. Let me know your questions. I really want to hear your questions about commission. I know that it can, there's lots of things out there that you might be wondering, and I want to answer them for you. The next thing you can do is watch our next video about how to calculate the debt to income ratio once we know what your average income is. Stay tuned.